something important changed. Instead of asking, is this true or false? Analysts were forced to now ask a much harder question. What are all the plausible explanations? So they changed the way the decisions were made. Every competing hypothesis had to be listed. Each one assigned a probability. And as new information came in, the probabilities were updated. Now, even if it meant admitting the original narrative was weakening, this approach became known as analysis of competing hypotheses. And the goal wasn't to predict the future with certainty. The goal was to avoid being confidently wrong. Because in intelligence work, being wrong isn't always the failure. Being certain and wrong is. And once you understand that distinction, you start to see the world completely differently. And markets work the exact same way. The future, it's uncertain, right? Information is incomplete. The narratives, they get really loud, and the cost of being wrong, it's not evenly distributed. Now, if you approach markets asking binary questions like, is this asset good or bad? Does this win or fail? Am I in or out? You're using the same decision model that caused intelligence failures. Because markets don't reward certainty, they reward process. They don't care how confident you are, they care whether your positioning makes sense given the odds. And once you see investing through that lens, the goal stops being about prediction, it starts being about handicapping. Now, let's look at the story most people are being told about Bitcoin, for example, and where that story starts to fall apart. The official story, it sounds reasonable, like Bitcoin's volatile. It's speculative. It's already up a lot. I could have got it cheaper before. Institutions are interested, but they're cautious. You know, they're waiting for regulation or stability or clarity. And the advice that comes from the story is familiar. Then we should diversify broadly. We should probably reduce our position size or concentration, avoid extremes. Now, in many environments, that advice makes sense. Like risk matters, volatility matters, position size matters. But here's the problem. That story treats Bitcoin like it's a normal asset in a normal cycle. It assumes that the future will look like the recent past. What it doesn't ask is a more important question. Is this a normal market? Or is this a transition? Because if you're inside a transition, then waiting for certainty doesn't reduce risk. It changes the odds. And the story doesn't break because it's completely wrong. It breaks because it leaves out the variables that decide outcomes during these regime shifts, these transitions. So instead of arguing opinions, if we dig in and we look at the structure, we can see there's 3 specific cracks that show up every time markets move through a regime shift like this one. Crack number 1, price is not the same thing as odds. Now, most people treat price like it's a probability, right? If the price is high, they assume the odds are low. If the price is low, they assume the odds are high. But that's not how markets work. Markets are not forecasting machines. They're allocation machines. Price tells you where transactions have